So every $100,000 invested, our investors were able to deduct roughly $95,000 against their income, including W-2 income. Depending on your tax situation and the state that you live in, that comes out to a 30 to 35K savings on your tax bill per 100K invested, which is pretty huge. Hey everyone, Keshav Kalur here, founder and principal of Clive Capital, and I'm joined here today with my partner John Lai. And we're excited to present to you today what we've been up to in Q1 of 2026. So let's get right into it. John will cover the economic overview, and then I will cover the portfolio performance, company updates, and what's next.
So if you want to follow us, feel free to visit our website, clivecap.com. You can also learn more about private equity investing by downloading our ebook here with the QR code, Investing Outside the Stock Market. Of course, you can follow us on YouTube by following this link or by going to this QR code. You can watch all the different episodes that we've recorded with subject matter experts on various asset classes. And then if you're a podcast listener like me, you can find us on your favorite podcast platform, Spotify, Apple Music, Amazon Music, and the like, by just going to the podcast platform and then looking for investing for generational wealth.
Okay, so Clive Capital, for those of you who are new to us, we underwrite and invest into institutional level opportunities worth tens, if not hundreds of millions of dollars, allowing our fund members to invest as little as $50,000 and diversify across many different opportunities across the entire country. So far, we've helped our investors invest, we'll cover this more later, but invest into more than 1,100 apartments under renovation, 100 single-family rental homes under construction, 14 industrial warehouses, 56 oil and gas wells, and private lending nationwide. And so our goal is to help 10,000 families achieve financial independence through a diversified portfolio of such investments in real estate, private lending, oil and gas, etc. And John and I both started out in the W-2 world, just investing in the stock market and riding the ups and downs that come with it, no passive income, no tax benefits. And we met in Amazon when we worked there together about 4.5, 5 years ago in 2021. And around that time, I made my first investment into a 108 unit apartment building in Texas, started seeing the passive income coming in. And at that point, figured, hey, this is how I'm going to build my wealth. And I want to help my friends and family, coworkers, etc., build their wealth this way as well. So started Clive Capital January of 2022. And here we are almost 4.5 years later.
And I'm John Lai. I have been investing chiefly in the public equity markets for the longest time as a W-2 employee. And it was about 5, 6 years ago that I started looking into private equity investments. And that's where Keshav and I met at Amazon. And since then have diversified my portfolio quite a bit into private equity markets. And as much as the past 3 years have seen a huge uptick in the public equity markets, private equity for me has gone even further up. So that's a testament to how private equity can diversify your portfolio. And especially in the turmoil of today's markets, it can definitely diversify and shield your portfolio from the ups and downs. Definitely listen to this quarterly podcast as well as reach out and find out more information about private equity investing. With that, let's get into the economic overview. There's a lot to cover, so I'm going to go quickly, but do reach out if you have any questions. First and foremost, macroeconomic overview. We know that the market, the GDP, has been growing steadily, probably a little bit higher than the Fed target or the Fed would like. You'll see that the PCE inflation index is about 2.4 to 3.6%. Fed is looking around 2%. That being said, unemployment is pretty stable, so that's great. But we are seeing, because of the tariffs, that happened beginning of this year. We're seeing the price of goods lifted around 7 to 11% effective rate. That means essentially it's leading to a little bit more inflation for our consumers. And then we also, of course, have the oil shock, which is also adding another 100 bips to inflation. So that is ongoing. And we'll talk a little bit about that in a bit. But the consumer sentiment in general is at a decade's low, despite the solid data that we've been receiving about the core inflation as well as unemployment. Interesting that the market is up and down these days. It's more recently has gone back up, but it's because of the nuances and the fluctuations and how we handle the tariff situation as well as the oil situation in Iran. Fed outlook is holding pretty steady. They held it steady in March of 2026. We're likely to see at the most one Fed cut sometime later this year if things cool. So the Fed is definitely looking at inflation and making sure that they're only cutting if they see that inflation has cooled. Our takeaway is that stagflation potentially is a possibility, especially if the Strait of Hormuz remains restricted. We're seeing the blockade there now. I'll talk a little bit about that in a bit, but that is also restricting and depressing consumer prices or increasing the price of oil. Essentially, it's increasing the downstream impact of infrastructure and goods. Good prices are increasing as well. From a commercial real estate perspective, we're seeing that the pain persists. If the Fed hasn't cut the rates, is not going to look to cut rates anytime soon, we're seeing that $3 trillion is maturing, and the consumer real estate market has to do something with that maturing debt, right? That also increases the cost of capital if the rates remain high. And then we then have to look at essentially underwriting at a more selective rate, at the exit rates of 5.5 to 6.5% across most sectors. We also have to avoid these bridging strategies, which essentially means short-term rates, rely on those and rely on a long-term rate cuts. That's probably not in the cards at the end of this year, at the very least. Okay, so worrying events, again, we talked about the Iran war, Strait of Hormuz being blockaded, double blockaded now. Hopefully that will resolve sometime soon. It began in February of 2026. We saw that because of that, 20% of global oil distribution is being disrupted, which is increasing WTI and Brent crude oil prices per barrel on the order of $94 to $120 per barrel. That fluctuates depending on the events, but that essentially has cut the distribution of oil by about 600 to almost 1 million barrels per day. That also in turn increases the price of food and fertilizer across most of the world, chiefly in Europe and in Asia, just because they rely on the oil that's coming out of that region. So our investment thesis, now analysts say the price of oil could go up $111, $137 per barrel. Realistically, if we do come to a truce, it will come down probably to around $100 per barrel, but the infrastructure still needs to be built up. It took two months to destroy it or so, and then analysts are saying it's going to take at least 6 months to build it back up. So it's not going to come back down overnight. Liquid natural gas, interestingly enough, because it's disrupted, it's impacted Asia and Europe more so than America. We actually produce liquid natural gas and we actually export that to different nations. So the impact to us hasn't been as severe, and we are benefited because of the Permian Basin. We get to drill oil and liquid natural gas out of the Permian Basin and other regions in the US, which is beneficial to us. If there is a ceasefire, we can compress prices. Here it says rapidly, but more realistically, it's going to take that 6 months for the oil prices to come back down, and actually in recession if prices don't come down pretty quickly. Ultimately, it's a buying opportunity for us because we rely on the last 5-year averages of WTI. And if we sell in this market, at least for the foreseeable future, then we'll be selling at a gain, which is beneficial. Other events that are a little bit distressing. We know of private credit, Blue Owl and its peers. It started with AI disruption concerns. If you think about AI and the concerns that it would negate the effectiveness of SaaS software providers or really disrupt what they're providing, those junk credits, junk bonds that are issued to the SaaS providers were then cut. And in fact, Moody's cut the outlook to a negative for Blue Owl. That triggered a redemption, basically a record high redemption request in Q1 2026 in a number of these private credit providers. So in turn, Blue Owl gated the liquidity of those funds. And that in turn affected other private equity, private credit providers like Blackstone, Apollo Ares, and the like. And that triggered a retail investor panic withdrawal. That said, a couple of mitigating factors. One is that's private credit, not private debt in general. Private debt in general, $165 billion raised in 2025, has historic lows in terms of defaults. So it's 1.25 versus a historic 2.5%, which is also pretty low. And then commercial real estate debt, we know that it's maturing. That's $3 trillion has to be serviced and it has to be replaced. So those loans will be replaced at a much more conservative rate, loan to value of 60 to 65% versus historically 70% and up in the prior cycle. And then banks are retrenching. They can't and they are unwilling to replace those loans. So someone has to step in. So these private credit providers will continue benefiting from the retrenchment. What that means for us is because of all these conservative underwriting and historically low default rates, we see it beneficial to continue investing in private debt. Again, private debt versus private credit of these junk credits, junk bond, junk credit funds. We continue investing in the private debt funds that are conservative in how they look at their borrowers with high credit scores, and we'll continue investing in these with tangible real estate assets. Just some really quick high level real estate trends. So multifamily had been going the last 5 years, 7 years or so in the downturn. It's starting to near its bottom. So starting down from the 40% of the 2022 peak, the supply is thinning. So we're seeing like the trough of it and coming back up, vacancy stabilizing. We're seeing value in Class B versus Class A. I think there's value in both, but the medium age of this rental stock has been increasing. 45 years is the medium age. So definitely CapEx is required. But we're also seeing a buy to rent premium. It's much more expensive, as many of us know, to buy a home versus rent. Renting is at a premium. And then renting is desired, much more desired than buying. And then we see that there's a value add thesis. We can go ahead and rehab older stock for workforce housing. So the best markets, you'll see some of the markets to watch down here: Charlotte, Houston, Vegas, Austin, Miami, Nashville, the ones that have new stock and historically has been oversupplied. And then from a retail mall perspective, we're seeing that Class A malls are surviving, especially those anchored by grocery establishments. We're also seeing power and lifestyle centers recovering. And Class B, Class C, these enclosed malls are still experiencing distress. We are avoiding those traditional malls, these enclosed malls versus open air malls. Open air malls in turn are gaining traction. They're easier to build and easier to deploy and redeploy. And then the oil shock, we are seeing that the oil shock has had some impact in retail. So we're watching that as well. Lastly, mobile home parks, resilient. It is trading at compressed rates. So we're definitely looking at it, trying to see if there's value in mobile home parks that we should be picking up. Okay, so our thesis generally is oil and gas. Let's stick with oil and gas because we invest in the US and we see value, continued value in the Permian Basin and other operators in that region. We also see and are looking and giving a keen eye toward multifamily in these constrained Midwest, Northeast markets, and then these value add opportunities with operators that we've worked with in the past and the new operators that have had some experience and we're working with them. Senior secured direct lending as well with the 8 to 10% yields. We're seeing those are great operators to continue working with. We're looking at others that have higher yields as well. And then other asset classes we're looking into hedge funds of uncorrelated broader equity markets. We want to make sure that if the market goes up and down, we're not impacted or our investments are not impacted as greatly with the investments that we hold. And then we're, of course, looking at retail as a defensive inflation adjusted opportunity. We're underweighting, like I said, developments that have oversupplied and then office core plus just because of these secular headwinds of maybe not going back to the office or reducing the workforce. So our thesis, as always, operational excellence versus financial engineering. We don't want to look for opportunities that are just rely on financial engineering. We also are looking for inflation resistant assets, whether that be energy or some type of option hedge funds strategy. We're looking at a liquidity premium. We realize that in the past, investments have had a 5 to 7 year hold. We're looking for much more liquid assets. And then we're staying selective. We're not jumping into every opportunity that comes our way. So with that, I'm going to turn it over to Keshav to go over our portfolio.
Thanks, John. As I mentioned towards the earlier part of the webinar, we have expanded to 1,100 apartments under renovation, 100 single-family rental homes under development, 14 industrial warehouses, and 56 oil and gas wells. Since the last time we recorded the quarterly webinar, probably it's the oil and gas wells number that's went up since we've been adding to the Iron Horse Energy Fund, oil and gas fund that we closed in December of last year, 2025. Here's a map of where all of our assets are located in pink. The light blue is where our investors are, but that needs some updating now that I'm looking at it. But the assets, you'll see that the industrial warehouses, the 14 of them that we've invested into through a fund that's in multiple states, that's shown by the icon with like a smoke tower, for lack of a better description.
Factory.
Factory, there we go. And then we have our apartment buildings that are shown with those townhome structures next to each other in Texas, South Carolina, and Virginia. The 100 single-family rental homes, that's all in Louisiana in one development. And then the oil and gas, I think they're called pump jacks, whatever, wells that you see in Oklahoma, Colorado, Wyoming, those 4 states. That's where our 56 wells are located across. And then, of course, private lending. We're lending to people nationwide there. So how are each of these asset classes, industries performing in our portfolio? Our apartment investments into Houston are performing below projections. And the big reason there is the Houston market, as did a lot of other markets in the southeast, like Austin, Atlanta, Phoenix in the southwest. A lot of these markets saw oversupply, overbuilding during COVID when rates were really low and a lot of people were moving down, and so builders just built. And we're finally working through all of that excess supply now. But what that has meant for the last few years is negative, or best case, stagnant rent growth. Couple that with expenses that continue to increase every year, and in Houston specifically, very prone to hurricane damage and other natural disasters, then our distributions are falling below where we would like them to be. And so just the learning lesson there is just to be mindful of these kind of boom and bust markets. Like a lot of your Class A markets can rise very quickly like this and then also come back down that same way. That's why sometimes we like our secondary markets. So our investments in Lynchburg, Virginia, in Myrtle Beach, South Carolina, those are much more stable and are performing at or above projections. So we're really excited about those. The one build-to-rent development that we've invested into in Louisiana is roughly at or below projections. There was a construction delay where the local government's requirements regarding sewer changed on us, and so that caused our budget to increase by about $1 million roughly, and delayed our construction by a year. But the out of 102 homes, 59 homes have been leased, and rents are continuing to increase in that market, as well as some of the additional income sources as well, like the amenity fee, for example. So we're really excited to see how this first ground up build to rent development project turns out. The industrial fund here, not a lot of news since Q4 2025. The distributions in Q3 were at 3.9% annualized, and here we are on track. We're just about coming up on the first year of acquiring assets, and during that time, there will be a cash drag on the portfolio because you don't have all of your assets, all of your capital completely deployed. And so your returns are going to be a little lower than you'd like. So in this year, once we've completed acquiring and deploying all the capital, by the end of this summer, 2026, then we anticipate that we'll start hitting that 6 to 8% cash flow that will continue to grow to keep in line with rents, inflation, and also just the reshoring of manufacturing that the current administration is prioritizing. That's definitely going to be a big tailwind for our investments into industrial real estate. Our mezzanine debt fund here, this opportunity is lending primarily to real estate investors nationwide. Not primarily, just to real estate investors nationwide who either fix and flip properties or they buy, renovate, refinance, repeat the BRRRR strategy. And we're coming up on a year and a half of investing into this fund, and it's been very consistent in terms of achieving roughly 15 to 16% returns for our investors. And its hold period is just 1 year. So you're achieving equity-like returns with lower risk because it's a private loan, and you don't have the typical lockup that a lot of real estate investments have. So it's really the best of most worlds, except for taxes, unfortunately. There's not a lot of tax benefits here. But that doesn't stop our investors from investing. So, and lastly, oil and gas. So far, we've invested into 56 wells, and 8 of those are in Wyoming, and another 8 of those are in North Dakota. And then the fund that we closed in December has 40 oil and gas wells that's spread across Colorado, Wyoming, North Dakota, and Oklahoma, 4 different states. Distributions have started already for the first 2 opportunities where we invested into 8 oil and gas wells. They are a bit below projections because of where oil price has been the last year. It's been a little depressed. But with the conflict that has started over the last 2 months and elevated oil prices, we'll have to see how how temporary or how long-lived these higher oil prices are, and then that will determine what the performance is of these funds. Typically, the oil contracts that these drilling companies set are for a certain period of time, whether it's monthly or quarterly, and it's fixed. So you don't really benefit or hurt, from the daily price fluctuations. That price that you sell oil and natural gas at is more or less set. And the latest fund that we closed, we are going to be starting distributions in May in a couple weeks. So we're really excited about that. And the other great thing with that last fund, the 40 wells, is we're able to get amazing tax deductions for our investors. So every $100,000 invested, our investors were able to deduct roughly $95,000 against their income, including W-2 income. Depending on your tax situation and the state that you live in, that comes out to a 30 to 35K savings on your tax bill per 100K invested, which is pretty huge. And with that, let's go to company updates. So very exciting news. We ended the first quarter, with almost $10 million raised. We were at $9,950,000. So I'm going to call it 10 million. We hit 10 million. Woohoo! Big party. It took us 4.5 years to get here, which is a little longer than I would have liked, but better late than never. And now we have a really good understanding of what kind of investments our investors like and what they don't like. And so what we've noticed is that they love their tax benefits. That is why 48% of our portfolio, roughly $5 million, is allocated into oil and gas because it provides tax benefits to reduce W-2 taxable income. And it also provides passive income as well. The runner-up is private debt at 31% of our portfolio, roughly $3.3 million. And our investors love that because of the fairly consistent passive income and the low lockup period of just 1 year. So after 1 year, if you want your money back, especially in an economy like this, where there's a lot of uncertainty around broader macroeconomic conditions, recession, AI-driven job layoffs, that liquidity is a very nice option, nice to have. Following that, and third is multifamily. We have roughly $1.6 million invested into multifamily value add opportunities. And there, our investors love multifamily because it's the middle of the road for all of the different things that we look for in an investment. It has tax benefits, although it can't help you offset W-2 taxes like oil and gas can. It has passive income and it has appreciation, and it's a very stable investment. And then we have 5% in industrial. We've found that's a little too safe for our investors and that they're looking for higher returns. And 1% in ground up build to rent. Their construction projects, investments typically take 3 to 4 years for you to see returns. And it's a harder investment for people to get into for their first time. A lot of the other investments, the other four that we have invested into, other four asset classes, cash flow from day one. And that's a big reason why investors love it. Yeah, in addition to that, we are now expanding into tax planning for our clients. So not just investments, but tax planning, retirement planning, estate planning, and insurance as well, with our end goal being to become your one-stop shop for all of your wealth and financial needs. So looking ahead for Q2 2026, here's what we have on the docket. So we're launching open office hours for anyone in the public to come join us on a Zoom call, ask any questions that they have about investing in general, about Clive Capital and what we do, about any investment or tax strategy that they're looking at. We would love to be your second set of eyes and just bounce ideas off of each other to tell you what we're seeing in the market, to learn more about what you're seeing in the market, and just all grow and learn together. So that'll be every 2 weeks on Wednesday. And here's a QR code to sign up for the open office hours. So definitely do that, and I look forward to seeing you there. Second is detailed fund performance reporting. Here, we've been something always pops up, and this last quarter it was just the explosion in the adoption of agentic AI, and that's what kept us busy. But with that and just the advances that Claude Code has made, I think creating our fund performance reporting will be a lot easier, just so that you all can see how our investments are performing on a monthly, quarterly basis. Beyond that, the advanced tax strategies and the additional wealth strategies that I mentioned, we're now expanding into and would love to chat with you about how we could help you take care of all aspects of your financial plan and not just the investments part of it. And lastly, upcoming investments. We're launching Bozeman Fund 2. That's the second private lending fund that we will be bringing to our investors. And there, we're looking at roughly 10 to 12% return for our investors annualized with just a 3-month lockup on their capital. So it's a great way to give us a try because the lockup period is so low, it's just 3 months. It's very low commitment. And you'll see results with starting 2 months because it's a private lending fund. So the passive income is pretty powerful. Every $100,000 invested, you'll roughly receive $1,000 a month in passive income. So it's pretty big. And we like to position it to our investors as an alternative to just letting their money sit and collect dust in a high yield savings account.
And the QR code is there if you want to watch the Bozeman Fund overview.
Yeah, and the second opportunity that we have coming up is Iron Horse Energy Fund 2. So we closed Fund 1 in December of 2025, a few months ago. It's going to start distributions in this upcoming month in May. We were able to get our investors a $95,000 deduction per $100,000 invested so that they could reduce their taxable income, including W-2. And so we want to help our investors do the same again this year. So the strategy is going to stay the same. And this is probably the last opportunity we have to buy at the previous acquisition pricing before all of these elevated oil prices work their way through and our price to acquire wells starts increasing also. So there's really a short window of opportunity here that we're looking to capitalize on and help our investors capitalize as well. Targeting an 18 to 20% IRR, investing into the top drilling companies that have drilled 1,000 plus wells. And again, this is for investors who want passive income and who want to reduce their taxable income, including W-2 income. Cash flow from day one with that favorable tax treatment. So, with that said, thank you everyone for joining us today to learn about what we were up to in Q1 of 2026. A very busy time for us, just given all the changes that's happening in the world, in the ways we work, and in all the things that we're seeing in the news and the economy every day. All of these things constantly inform us about how we're going to be pivoting and reallocating, readjusting our portfolio for our investors. And we're really excited for what Q2 has in store. So we're expanding into a lot of different other arenas to help you take better care of your loved ones, of your financial plan, etc., through investments, tax planning, and more. Would love to chat about any of it. We have our contact information here, so call us, text us, email us, schedule a call, and we'd love to get to know you and work with you. So,
Yep.
without further ado, that was our Q1 2026 recap. And thank you everyone for listening and see you in a couple of months at the end of Q2.
Thank you, everyone. Looking forward to the rest of this year.